And it is Wednesday, so it's Q&A. And we do these every single week, three times a week on Mondays, Wednesdays, and Fridays. So a lot of people send in questions. It's great if you send in questions of if you have some successes. Hey, Lori, did finally Torrance close on that deal or no? Yeah, Desiree, you got to tell us if Torrance closed on the deal or not. So. This is Torrance's first deal in Mastery, right? So he's all excited, and we made a video. He had done a dry closing a couple days ago, and I'm like dying to release his video because I think it's exciting, right? Whenever somebody's doing their very, very first property. But I was like, let's just make sure the deal gets funded before we say, oh my God, congratulations. So hopefully his deal will get funded, I think, and then we will talk. Anyways, so the whole point of this is we talk about what is going on in the marketplace, what is happening, what is live, and then we answer some of your Q&A questions. And the only way the community grows is if you invite your friends, your family, other people, other fellow investors that may have a interest in real estate. So having said that, let's jump into it. So the first question was related to the question the other day I had addressed was a couple that had $160,000 invested in a property in Ohio. And we were talking about this on Monday. And somebody followed up and they say, Andrew, they're getting a 4% cash on cash rate of return. They have equity in the property now because they've held the property for 3 years. And of course, we all know the property price have gone up. But are you saying this is actually good? I'm not saying this is actually good in terms of cash on cash return. And even the other option I had given them was an option where they could basically switch those, invest in Chicago, and very, very conservatively get about a 10-15% return, cash on their investment. Even that, I'm not saying that is good. The reason why I did say that what they were doing is great is these are folks that showed up at the 3-day. At that time, they had zero investments 3 years ago. They had never done anything. And then they got busy, but they basically at least went out and they bought something, right? They did something. And it's not the numbers we want to see. Generally in Mastery, the minimum numbers that we want to see is this, right? If you're doing a flip, so I want to give you both the numbers, right? On a wholesale, it's difficult to say, well, what are you going to make, right? Some people in Mastery have made $500, $2,000 on. Matthew did a wholesale. I think he made $2,000 or $3,000. I believe he didn't make that much money, but that was his first deal, right? It's okay. It's a big, huge win because for people who haven't done it, right? It's like, oh my God, man, all he made was $2,000. But guess what? The amount that he got to learn from it, right? Guys, listen. I have a friend of mine, Barton, right? So his son. Barton's son happens to be he wants to be basically the next, the NASCAR racer, right? Guess what happened, right? They buy a little Miata, he gets an engine, goes to Joliet Raceway, and guess what happens? He comes in very, very last, right? He's all passionate, his dad is supporting him, and guess what happens? Comes in last. What are you going to tell your son? Oh my God, son, you're a loser. You basically lost the race and you didn't come in first? No. But then guess what has happened? Over the last year or so, he just won his first race. Now he's going to start building up. It doesn't really matter what it is. And what I'm trying to say is this, that so with wholesales, in Matthew's case, I think he made $2,000-3,000. In Jennifer's case, she works on this file for 6 months. She made about $10,000 or $9,500, something like that, right? So I've made anywhere from zero all the way to $120,000 on a wholesale. But let's not talk about that today. So when we think about what is a good result, we're not going to talk about wholesales because that is hard to look at because you don't have any cash invested. Yet, for cash on cash return. So, hey, Joseph, can you maybe turn this way? Yeah. So we can write it down here. Okay, so cash on cash return. So think about this. If I am doing a flip on a property, in terms of a cash on cash return, what does that mean? So when you do a flip, you can have one of two things, right? You have either money out of your own pocket, which you have some cash that you invested, or number two, you may have borrowed the money from somebody, or that's fine also, or you may have partnered with somebody, right? That's perfectly fine. So if you're using, so I'm just going to put a number here because it's easier to understand a number. So assume that you have $150,000 in terms of your purchase price on a flip, right? And then you're doing, in terms of rehab, you're going to do another $50,000 in terms of a rehab. So basically you have about 200,000 invested in this deal, right? So this is going to be your total investment, right? Now, if you pay cash for this deal, right? If you paid cash for the deal, then guess what happens? If you paid cash for it, then you have 200K that is going to come from you. Let's say you basically paid 200,000 from your savings, right? So 200K from your savings versus if I do a deal and I borrow, so this is borrowed money, I borrow 200,000, right? From a lender, from a hard money lender, from a private money lender. And after I pay the hard money lender or I pay the private money lender, I make a return on the investment. So let's take the property that I'm just doing. We got multiple offers on that property. I had said I was going to make 45,000 in profit. I'm going to probably end up making about 50, 55, right? So let me just use a number of 50K. I'm a little bit less than what actually the profit's going to be, but I'm just using a number 50K. So I make a 50K profit after I pay the lender, after everything's done. Now, for you, you make the same exact amount of profit, which is 50K. Now, is the rate of return the same in both the cases, right? The rate of return in both the cases is not going to be the same, right? Why is it not going to be? There are shadows, man. Where's the shadow coming from? There's shadow coming from somewhere. Anyways, let's not worry about it. Okay, so if I look at a 200,000 investment and I make a 50,000. Oh, okay.
Yeah.
Okay.
So where the bright spots are.
Oh, okay. I make a $50,000 return versus on 200,000 I make 50,000. In this case, this money was not my money. Right? This money was not my money. I had borrowed the money, so I've already paid a return to the lender, and I made 50,000 bucks. Which, in this case, this is absolutely fantastic. Right? Here, I have not accounted for what I would have paid myself. So if I say, okay, both these deals were done in 6 months, right? 6 months is what time it took to do both these deals. In this case, I truly made $50,000 after all expenses. In this case, if I account for all the expenses that would have been associated with borrowing the money from somebody else, right? My actual profit in this case would be about $32,000. Now, there's nothing wrong with you saying, but Andrew, I have the cash to do it, right? So if you have the cash to do it, it's fantastic. That's great. The problem is this. This is not your true profit, because if you are basically putting in your cash, you should account for how much you are basically not making on the money that you have invested in the deal. So for me, for every 100,000 that I invest, right? So then I have to get at least a 14, 15% return on my money before I count my profits. Right? Before I count my profits. So if you look at my portfolio right now, right, I'm trying to scale up with Airbnbs. So I was just telling Lori yesterday, I feel so poor because there's $2, $3, $4 million, $3 million almost that I can't account for. I have no idea what it is. It's not like I didn't go gamble it. I didn't go do something crazy with it. I just bought a lot of real estate. And then what happens is in every property, you're spending 30, 40, 50, 30, 40, 50, 30, 40, 50. I think we have 20 something rehabs, refinances that I need to do. Right? Now, when you have that many refinances you have to do, every property you spend 40, 50, 40, 50, 40, 50. And then you have bigger expenses out there for just stuff, right? Office, this, that, all this stuff. You're like, oh my God, right? This money is not there. So when I look at my profits, right, if that money is being used in a property and if I'm not getting a return on it, so to scale up with the Airbnbs, I ended up putting a ton of money out. There's a ton of money in furniture. There's a ton of money in making the properties a little bit nicer. There's a ton of money. So what that happens is now people will look at it and go, oh my God, Andrew suddenly has got 25 Airbnbs from zero. Well, guess what? There's a cost to it, is what I'm trying to say. So the other day, I had said for these people that had started from zero, at least they did something. But if we look at their returns in Mastery, right? A return in Mastery for if you did a flip and you made a 15, 20% return and you basically kept doing that, we would consider that a very poor return in Mastery, mind you, right? In Mastery on a flip, for every 100,000 that you invest, right, from your pocket, not only you need to get a 10 or 12% return, 15% return on your money, on top of that, you need to be making at least 20,000 for every 100,000 that you invest. What that means is this: if I buy a property for say 150 in this case, and I do a $50,000 rehab, if I'm not making a minimum of $50,000 in net profit, right? Guess what, right? It's a really bad deal. I put out cash out of my pocket if I'm not getting 15, 20% return, because if I had put that same amount of money in a rental, right? Even in a bad rental, what is my cash on cash return? A bad Airbnb, my cash on cash return is somewhere around 40 or 50% cash on cash, right? So why am I tying that up in a flip? Because then it does not make sense. So I just wanted to clarify that point because a couple of people brought it up. They're like, Andrew, for 10, 12%. I mean, to me, less than a 30 or 40% cash on cash return in real estate, we're talking about when you're an active real estate investor. If you're getting less than that profit, there is something wrong. Why? Because you're actively working in the business. Now, if it's passive and you get a 15, 20% return and you're happy as could be, God bless you. But if you're actively in the business, right? So if I make 30, 40,000 bucks on a flip and I have a bunch of money invested in there, shame on me, right? You'll never hear me claim, oh my God, I made 40,000 bucks and I killed it. No, I don't consider that a successful flip. I consider that, as far as I'm concerned, as a failure. Now, you may look at it, you're like, Andrew, you're crazy. Well, I'm not crazy because I run a business, right? When you run a business, you have to look at everything like a business. Now, I know for people who don't do this as a business, $30,000, $40,000 in profit may sound like a lot of money, right? But yet, when you run a business of real estate, that is not a lot of money. That is chump change, right? So you have to kind of keep this in perspective. But these people, I was trying to encourage them because, like a lot of people, they don't do anything. They'll come to a 3-day, oh my God, this was great. I learned so much. Thank you so much, Andrew. And they'll walk out, right? And yet these people did something. Not only did they do something, then 3 years later, they're looking at it. They're like, is this the best possible thing? No, we can do better. And now they're making their way into Mastery, where we will want them to restructure their entire business. So anyways, I just wanted to go back to that particular point. Now, the next question was, can you explain 1031 exchange in a simple way so I can understand, right? Because it's a complicated question they asked for a 1031. So I'll just kind of explain this in a very simplistic way, so hopefully everybody can understand. So number one, why do we do a 1031 exchange? Let's understand that first, right? What's the reason for it? So we do a 1031 exchange because you, me, whoever it is, bought a property 2, 3, 4 years ago, more than a year, right? More than a year. It was rented out for some amount of time. That the criteria threshold for that is a year. Right? So if I buy a house and I live in it, so let's say you buy a house, you buy it for 100,000 or 500,000, really makes no difference, right? And let's just say you sell it and you make 100,000 profit, right? Now, if it's a home that you're living in, it's exempt, right? You're not going to pay tax on that money because you lived in that house. And naturally, most of the times what people do is they'll go out and buy another house. Right? So on your personal residence, and it's exempt for couples, it's a 750 or something amount. For singles, it's up to a $500,000 amount. And I might be a little off on that. You can look it up, but it's something like that, right? It's a lifetime sort of a thing, that it can't be that you bought the property for 20 million, sold it for 40 million. Not all of that is exempt, but your personal house, there is a limit. What is that exempt? Most people are never going to reach that limit, so you don't need to worry about it, right? But you can look it up. For a single, it's less. For a couple, it's more. But if this is not your personal residence and it's not a flip, right? It's a property that you had it rented, and let's say it's been 5 years and now you're going to sell it. So when you sell the property, and I'll just make this example, this person's numbers are a little complicated, but I'll make this very, very simple so everybody can understand. So I'm going to even out the numbers so you understand. In this particular case, the person bought this particular property for 110. Right? It's actually a little odd number, but I'm just making it 110 for round number purposes. Now they're selling this particular property for, and their net in this, after everything's said and done, is somewhere around 300,000 is what they're selling the property, right? For people who need a point of reference, this is Glendale Heights, right? So when you look at 110 purchase, now they're selling it for 300. They've owned the property for the last 3, 4, 5 years, right? And now they're selling it. And now they're selling it, so they're going to have a gain in the property, and the gain is going to be somewhere around $200-some thousand, right? So now what do? Now you have two choices. You take the gain, you add the depreciation that you took in the property. Let's just say the depreciation was another $30,000, right? So then you're going to have to pay tax on the recapture of depreciation. What the IRS says is, hey, we gave you a benefit for owning real estate. So this is something most people don't realize. So they're like, oh my God, I can understand paying a tax on my gain. My gain was this. I can understand paying a tax on it. But why is the recapture being added? Because IRS gave you that advantage. So then they say, hey, you got to give it back to us whenever you sell a property. So what a lot of people do is, instead of doing this, right? Because what would happen is you'd end up paying tax on $230,000, right? Now, you could do that, but if you're going to reinvest that money anyways, right? Let's say you're not going to go take this money, do something else with it. If you're going to reinvest it back into real estate, what people do is what is called a tax deferred exchange, or also known as a 1031 Starker exchange, right? So a tax defer, it doesn't mean tax free. It defer. What does that mean? You're deferring it for a later time, right? So you're saying, hey, Mr. IRS, I'm not going to pay the tax now, I'm going to do a tax deferral. So what happens is that this amount of money, right? This amount of money, 200,000, doesn't go to you at the time of closing. It goes to a company that handles this particular thing for you. So if you're working with Fidelity, they have a division that does that. So the 200,000 is going to go there, and you have to set this up before you go to the closing. So don't go to the closing and say, oh, I want to do a tax deferred exchange, by the way. No, you have to set this up a couple of weeks ahead, right? They'll file all the paperwork, they'll get everything set up for you, and you have this thing set up. Now, with a 1031, before you do a 1031, what is important is to understand, when we do a 1031, what are we doing? We're selling an asset and we're buying another asset. And the IRS gives you some time, because it's almost impossible to say, oh my God, I'm going to sell my property today, I'm going to buy a second property today. That's very hard to line that up. You may need this money from here to here to be able to close on the next property. So they give you 45 days to identify the next asset, right? Whatever your next asset is going to be. Now, can you do it? Can you start looking for it ahead of time? Absolutely, right? So you can do that ahead of time. You can start looking for that ahead of time. And then you have 6 months to close it, right? So this is why people do a 1031 exchange, right? That you can, the reason for doing that is, why would I want to go pay tax on a asset that I'm going to reinvest the money anyways. So then why would I go and pay tax on it? Because now I can use the money that I would have paid tax with to buy more real estate, right? And then let's just say 5 years from now, I again sell the property. Now this gain became from 200 to 600, right? My gain is 600. Well, guess what I can do? If I'm going to reinvest that money again, I can literally go buy more real estate and it turns into $1 million. It really doesn't matter what this number is as long as I don't touch it. I follow the IRS code. I do it within the 45 days and 6 months. That's the rule right now, right? And I buy properties of equal or greater value, right? Equal or greater value. I can keep deferring that until the day I'm dead. When the day that I'm dead, that day, if I give it to the next of kin, whoever that is, if you have kids, for me, maybe my sister, spouse, whatever the case may be, your kid, your cousins, your nieces, nephews, whatever it is. Now they inherit that property at that stepped up tax basis, right? So what they've done is all your life, you deferred the taxes because you kept buying more real estate, and then you went ahead and passed it on to the next generation, and they get the step up in tax basis. Real estate, why people invest in real estate is not just for cash flow. People invest in real estate because it is, number one, the best protection against inflation, right? The best protection. Any country in the world where inflation is rampant, guess what people do? They double down and buy real estate. Why? Because you don't have to do anything. It will equal to and beat inflation every single time, right? Why? Because how do people buy real estate? The next guy who's going to buy real estate, how are they going to buy it? They're going to buy it with cash. And if the cash has lost monetary value, automatically your real estate, you'll get paid more for it. Here's the good part. Think about if I had, before the pandemic starts, right? A few hundred houses, and let's just say, I'm just going to make up a number, you have $10 million in debt, right? You have $10 million in debt, 100,000, 80,000, 200,000 on different houses, right? Guess what happened after the pandemic? Guys, you realize that we have lost close to 20 to 25% value on the dollar in the last 3 years. So what happened? People who had a lot of real estate and they had debt with it, their debt effectively from $10 million became 7.5. Why? Because the power of the dollar, right, to buy something went down because of inflation, right? So my total debt, right, it went down. In the meantime, what happened to the property values? Property values went up and my debt went down. And I didn't do anything to deserve it and or earn it. The federal government did it for me. Our politicians did it for me by printing more dollars, right? That's why they inherently, like a lot of times why people end up very wealthy with real estate is not based on a lot of what they do, right? For me, I bought obviously a lot of real estate. A lot of people from Mastery, they bought tons and tons and tons of real estate. But you know what really builds wealth? If you really look at, for me, in the last 10 years, right? I put in a lot of work, true. But guess what really builds wealth? So if you look at my portfolio today, or if you look at Rahul's portfolio today, this is 2-3 years ago, I'll never forget this, when I had the other airplane, Rahul and I were going down somewhere. I don't remember where it was. We're going down somewhere. We're in the airplane, and I made a comment to him. And I'm like, dude, you realize that you're going to be, if you don't do anything from now until the day you're dead, right? Your kids, your damn kids are going to end up with a portfolio of, 20, 30 million bucks for doing nothing. Because why? You already own, he's like, you think so, man? Right? Rahul is a very much of a realist. And he's like, you think so? I'm like, no, not I think so, I know so. Then a few months later, he comes back to me. He's like, man, I sat down and I looked at the numbers. You're right. And I'm like, it's not because as an engineer, right? It doesn't matter who you are. You're never going to make that kind of money. It's impossible. For 99.99999% of all of us, including me, right? to make that kind of money and to save that kind of money is impossible, next to impossible, right? There's some people may be able to do it, but that's going to be less, 0.000001%, right? But to invest for it, guess what? That is 100% possible for you and for I. And 1031 is one of those ways that real estate has depreciation. It's a hedge against inflation, and you can do a lot of things with it that you cannot do with anything else, right? And this is something really, really important that we fail to, even I fail to mention this all the time, that what you can do with it. So I'll give you guys, I know somebody, I'm not going to tell you who, but anyways, I know somebody that the property was bought for $52,000, right? 3 or 4 years later, it was sold, and there was a gain of $210 on this property, right? They took this money, reinvested it in 2, 3, 4 more properties. Once the money was reinvested, they took out a loan against it, a refi for this, against this, for $150,000, right? $150K. Then, and again, 2 or 3 years later, that same money was reinvested. There was another $236,000, something like that. I don't remember the exact number, something like that in profit. Then they did another refi and pulled out another $200,000, right? And now they're on their set number 3. The cool part about real estate is that there's so many fun things you could do with it. It just depends on, do you know what you are doing? So hopefully that makes sense. Now, the next question was, where to go? How do I take out an FHA loan from a seller? He's trying to sell a 2-unit building. We can take over the FHA loan into an LLC, or is it an assumable loan? What are the options, or what can we do with a subject to mortgage FHA from seller to LLC? So if this is an assumable loan, you qualify for the assumption, then guess what? You can assume the loan. Once you assume the loan, at that point, can you move the property to an LLC? You can, right? Nobody can stop you from doing it. Could they, in some rare cases, call the loan due? Yes, they can, right? But can you basically assume the loan? If it's an assumable loan, you have to look, is it an assumable loan? Now, most of the assumable loans are fairly old. I believe last time they did those were in 90s, if I remember correctly. If not the 80s, the assumable loans, most of them have gone. If you can do that, and if you qualify for that, you can very well assume it. There are some assumable loans that are still, and that still may be out there. There's probably not a whole lot left on there. So if it makes sense to assume the loan and the numbers all work out, then sure, absolutely, you can do that. But you just have to know the numbers. You haven't sent me any numbers on this. Otherwise, I could be more than happy to basically break those numbers down for you and show you whether it would make sense to assume it with a subject to or not. So your question is, can you do it? The answer is yes, you can do it. But the answer is also it depends, because I don't have the answer. I don't have the numbers. So I don't know exactly specifically how to answer your question. The next question was, I'm buying a property. This was something that somebody actually in Mastery asked today, which is that they're going to buy 2 or 3 properties and they're going to do flips with a partner. So this is the situation. It's somebody from Mastery, we'll just call her T. The other person we will call M, right? So there are 2 people. T and M. So for this person happens to be from Mastery. So her question was, hey, we're going to basically start with 2 LLCs and then we're going to combine them, right? And I know maybe she wasn't stating this correctly, but this is what she was trying to basically say, is that, hey, then we're going to do it together. What our suggestion to you always is this, that if you're going to do flips and you're going to do that in a partnership, right? What you can do is you can decide one way, number one, who's going to provide the money. So let's just say we say, okay, this person is going to be on the hook for money. And so that means they're on the hook in terms of credit. Now, what if they borrowed the money from a private money lender? Still, if they're signing for the loan, then in my opinion, this is my opinion, right? Then they should control whose name the property goes in. So it should be in this person's name, and then you can have a partnership agreement between this LLC and this person, right? This LLC. Now, can you do that as individuals? Yes, you can, right? Now, if you have not known the other party for a long period of time, and unless you have not done business with them, something hasn't gone wrong, and they've done right by it, I would not suggest that both of you go on one LLC as member 1 and member 2. Why? Because if this person goes out and does something screwy, guess what's going to happen? It's going to affect you. That's why you don't go and form an LLC with 2 partners, because the other partner's actions will have a negative impact on your finances. See, I don't want somebody else to control my destiny, right? Now, if I own the property under my LLC, and now this person cannot sign for my LLC. So at the end of the day, I may have a partnership agreement with them. We can have a partnership fight, but they cannot harm the property. And the reason why I say that is this: and I have done this, guys, I've done this where I have trusted people, and the people that I trusted the most. I've done this 2 times. This has come back to bite me 2 times. Both of the times, I never in a lifetime thought that these people would cause me financial harm, right? One person, I had to sue them and spend $450,000 in court for 5 years, literally to prove my point over a few $100,000. We won across the board, right? The second one is another bastard who I'm going to go after, but that's a different story. I'm not going to get into that today. But you cannot go just say, oh, this person is a nice person. You got to run this as a business. We all do it. We all get carried away, and I'm the first person to admit it that I've done this, right? So I would highly suggest to you, don't do it. So if you're going to do a flip, you have 2 choices, 2 ways of doing that, right? Number 1, you have to decide, right? The first thing to decide is, okay, who are the 2 partners, partner 1 and partner 2? Now, the second thing you have to decide is that you're going to do it in personal name, or are you going to do it with an entity, LLC, right? The third thing is, who's going to hold title, meaning who's going to be the owner of record legally, right? This is just my suggestion to you, that let's say you own this person owns one LLC, this person owns a second LLC. Do you have to do it within an LLC? No, you don't. You can buy the property in a personal name. Is there anything wrong with it? No, there's not, right? Generally, when you start doing a lot of transactions, you should do it in a separate LLC, so it separates you from you as a person, right? In terms of lawsuit, all that kind of stuff, right? The first thing you have to decide is, hey, who's going to basically own the property? So hypothetically, let's just say in this case, this person is going to bring the money to the table, or they're using their credit, right? This person, let's say, number 2, found the property, and they're going to get the rehab done, which is fine, right? If it's me, this is just me, I'm going to want to own the property in my LLC, right? In my LLC, I'm going to want to own that property. So this house, I'm going to want to own it there. And then my LLC can sign a contract with party 2 or with their LLC as a partnership. So it's a flip partnership contract, which spells out exactly who brought the money to the table, or who put up their credit, who is going to own the property, in what name, who's going to do the rehab, who's going to handle day-to-day functions, who's going to sell the property, how are we going to split the profits and or losses. You have to think about not just profits and or losses. If we get into a argument, if we have disagreement about something, how are we going to resolve this? Are we going to go to court, sue each other, which is probably not productive, or are we going to basically arbitrate this with some sort of a binding arbitration, so that both people try to get it resolved in a simpler manner rather than turning it into a lawsuit? So this is something that you have to decide. So that's how I would do it. I would do it where I would own the property in one LLC. I would sign a joint venture agreement with the other one, like a partnership, and I would do it that way. Do a few transactions that way. Once you feel, oh my God, I really have seen whenever we get in a tough situation, this person still comes through. They still, are good to their word. At that point, if you want to go both of you in one LLC, then that makes sense, right? Otherwise, if you have whose ever neck is on the line should be controlling person in that LLC. Don't go in the LLC and put yourself in harm's way, because now what the other person does will control your destiny, right? So this is really, really important to keep at the back of your mind, that whenever you're doing a partnership, the immediate thing, what most people end up doing, right? And this is not something that I would suggest at all. And I'm basing this on experience, right? Don't go and just set up an LLC with a person that you just met, or you're like, oh my God, this is a nice person. They seem so good. Great. They seem honest. Great. Let them prove it, right? I'm not saying don't trust people, but trust and verify. And you do not trust somebody unless they have been through a hard time. Everybody is great when things are going great. The second somebody loses money, that's where the real character comes through. So that's something really, really important. So whenever people ask this question, well, should I do an LLC? Should I do an S Corp? What should I do? Well, it depends on what your scenario is. Are you buying a property to rent? Are you buying a property for a flip? Are you going to just do wholesales? What is your intent with the given property? Number two, who's on the hook? Meaning, if one person has nothing, right? They have zero to lose. They're like, oh yeah, I'm a really hard worker. I do rehabs. I can work really hard. Great, wonderful. Does your skill set have value? Absolutely. But do you have anything to lose? No. Why? Because tomorrow you decide to walk away because things are not working out. Guess what? The person who has the money is going to have all the liability, right? They're going to have the liability. When I had nothing, right? And I basically ran into somebody. I had an accident. What are they going to do? I'm broke. I'm dead broke. Besides my insurance, there's nothing they can go after, right? But when you have something, guess what? Now, even if it is not your fault, somebody is going to look for, oh my God, maybe I can harass him enough so he will just get a payout on it, right? Because it's based on who has more to lose. And whenever you ever, and I've done this and I've suffered the consequence, when you do, the most dangerous person is not a crook. The most dangerous person is a person who has nothing to lose. Because if you have nothing to lose and you get in a civil litigation, they have nothing, right? They overspent a bunch of money. They did a bunch of stupid things. You realize that if it's a civil litigation, you're not going to win. Even if you win on paper, how are you going to collect anything from them because they have nothing, right? So this is really important to understand that whenever you're going to do a flip. So here's what it would look like. Here's partner one, right? They have an LLC. The property sits within that particular LLC. This is the property. And then the second person can have a joint venture with this LLC back and forth that, hey, we have a partnership agreement. This is what we're going to do, right? And that's that. Or they can have their own LLC and the two LLCs can have a partnership agreement. Perfectly fine. What I would not suggest you do is something like this, which is that the two of you go in on a joint LLC, partner one, partner two, so member one, member two together. Because now you are basically in a world of hurt. Because if this person does something crazy, doesn't want to go along, something goes wrong, now you need their signatures to be able to sell the property, and your credit may be on the hook, your money may be on the hook, and now you're stuck, right? So I would highly suggest that don't go do that unless you have history with somebody. So I hope that answers that question. The next question and the last question was, what is the risk when I'm buying a property at auction, right? This is a question, guys, I'm going to deal with next on Friday. We will deal with this because this is a little bit longer question. So generally, there are only two types of auctions that take place. One is the sheriff sale, also known as trustee sale. And this is something we have talked about, right? This type of property has a lot of risk, right? All the risk in the world is generally with these properties. The second type of properties are properties that are REO auctions. What does that mean? So these are bank-owned properties that they auction off. The risk here is very, very minimal, right? Very, very minimal. Here, if they sell you other day, this is just the other day, there was a property that was going to auction. The lien on this property was lien number 2 that was going to auction, and the lien number 2, $34,000. It sold at auction for $79,000. Guess what? How much the house is worth? The house is worth $250,000, and there's a lien number 1 on the property for $152,000, right? But what happens is when it goes to sheriff's sale, they don't tell you whether it's lien number 1 that's going to auction, whether it's lien number 2. They're just selling you a case number. They're selling you a file, right? So if you bought the wrong file, and a lot of times people think, well, isn't the lien number 1 going to go to sale first? No. Any lien, whichever bank basically starts a foreclosure first, gets it to the foreclosure sale, that's what's going to go to foreclosure sale, right? And if the bank 2 sells the property at auction, you legitimately own the property subject to loan number 1. But that's something, it's a little bit more broader topic. So, and there's a lot of more stuff that we can talk about. Obviously, how do you buy a property without looking at the outside of it? What if the property burns down from the time when you buy the property to the time when you actually get the deed to it? There's a whole lot more to it, right? So we will discuss that. This is the first thing that we will get into on Friday. Having said that, have a beautiful Wednesday, and we will talk to you soon. I got to do the mastery call because today is the lady for Section 8 that is coming in. Thanks a bunch, and have a good day.